Look, we're living in wild times. A crash still feels inevitable. We're unpacking the why and possible how. And let's get ready together. Hey everyone, welcome back to Money Talks. I'm your host, Chris Lee. Today, we're going to dive into what causes stock market crashes and the bear markets. Look, we're living in wild times. Stocks at nosebleed valuations. Wall Street insider dumping shares like it's going out of style, and whispers of extreme scenario like a CCP's invasion of Taiwan lurking in the shadows. But even without that kind of geopolitical fireworks, history tells us crashes can still hit hard. Today, we're unpacking the why behind those meltdowns, so you're not going to caught off guard. So here's our roadmap. Number one, crashes caused by mechanical failure when the system itself goes haywire. Number two, crashes and bear markets driven by fundamentals, the business cycle and interest rates. Number three, are we in a bubble now, and how fiscal dominance is twisting the picture. And finally, number four, AI doom loop, terrifying new threat on the horizon. So feel free to jump to any sections with the timestamps we show. Next time, we're going to roll out simple and advanced strategies to shield your portfolio from a crash or a bear market storm. Let's get to it. First, level set. What is stock market crash? Picture a sharp, big drop, like close to 10% or even more, in the S&P 500 over a day or two or week or even maybe a couple weeks. It's a gut punch, fast and brutal. A bear market though, that's a slower burn, 20% plus drop from a peak, and it lingers until stocks claw back past the high. Could take months, could take years. Here's the twist. A crash doesn't always mean a bear market follows. Sometimes it's a quick scare, like a roller coaster dip, and we're back on track. Other times, it's a start of a long, dark tunnel. So what lights the fuse? Two big culprits: mechanical glitches and economic fundamentals. Let's unpack those now. All right, let's kick off with crashes where the machinery, not the economy, stole the show. First up, Black Monday, October 19, 1987. Imagine the Dow tanking 22% in one day. $500 billion market cap vaporized. It was a mechanical meltdown. Big players like pension funds had what they call portfolio insurance. It's a fancy algorithm set to auto-sell stocks if price dip too far. Sounds smart, right? Until a jittery market triggered those bots to flood the system with sell orders. Add in short selling, hedging put options, and index futures selling. Man, it was a perfect storm. Then came the gut punch. New York Stock Exchange's ticker lagged hours behind. Brokers were drowning, and systems choked like highway pileups. By day's end, it was a financial bloodbath. But here's the kicker. The economy was fine. Reagan-era GDP was humming, unemployment was down, inflation tame, no big bubbles in stock and other assets prior to crash. So, no bear market followed. Confidence roared back, and the bull keep charging. Regulators slapped on circuit breakers for meltdown and tame those wild bots. Fast forward to May 6, 2010. The flash crash right during the recovery after 08-09 Great Recession. The Dow plunges nearly 1,000 points, 9%, in minutes. Sure, European debt crisis was simmering, but that was all high-frequency tradings, HFT, gone rogue. A $4.1 billion sell order in S&P futures hit the market. It's not huge, but the HFT algos grab it, ping-pong it at light speed, and drain the liquidity dry. No buyers, just free falls. Blue chip stocks like a P&G crushed to pennies, can you imagine? Others spiked to 100 grand. It's total insanity. And the SEC later fined firms like Knight Capitals and tightened rules. But the market snapped back in days thanks to the ongoing post-2009 Fed stimulus and the fact it was just a liquidity hiccup, not an economic gut punch. Now, let's switch gears to the real deal. The crashes in the bear markets tied to the economy's heartbeat, the business cycle. Stocks and the economy are like dance partners. When business boom, profits soar and stock price climb. When the music stops, loss pile up, the markets crash. But here's the catch. Stock market is like a fortune teller. It sniffs trouble months before recession is official. Look at 2007. The S&P peaked in October, but the Great Recession didn't start until December. Or 2001, stocks topped out in September 2000 S&P, 6 months before the downturn hit. Investors sees earnings dip, feel rate hikes, or just get spooked and they bolt. If you peeked at a chart, you will see the stock market cycle in blue jumping ahead of the economical cycle in yellow. And take the dot-com crash in 2000. The Nasdaq hit a little over 5,000 peak on March 10. Then bam, dropped 25% within a week in April 2000. Tech stocks, puffed up by hype, collapsed as the investor realized the emperor had no clothes. The bubble popped, kicking off a bear market that dragged alongside the early 2000 recessions. Tech dreams shattered, Nasdaq tanked by 78% in total, a ghost town for years. Then there's October 2008, right after Lehman Brothers imploded. The Dow shed 22% in 10 days. S&P 18%. Panic rules as the financial system wobbled. That crash was one of the craziest moments of a nasty bear market tied to the Great Recession. S&P lost 57% in total. These are not glitchers. They were fundamental: business bleeding, debt imploding, and economy spiraling. So how does the business cycle spin? 4 phases. First up, recovery. The economy is picking up after recession. Businesses are lean and mean from surviving the downturn. Unemployment is high and everyone is offering deals to get shoppers spending. The central banks keeps interest rates low to boost jobs, and slowly people and companies start borrowing to buy stuff or invest to grow. It's cheap money, cheap stocks. Everyone is bargain hunting. Now next comes growth or expansion. Things are humming along, jobs is up, debt is up, fueling spending, and the central bank nudges rates up just a little, and stock and other assets still look good price-wise. Then there's the bubble. Greed kicks in. After years of rising stock or real estate prices, people borrow big for houses. Investors load up on margin debt for stocks, and the business grab debt to expand to buy back shares. Prices go nuts, inflation tick up, and the central bank hikes the rates. The smart investors get worried. Sometimes it's a stock bubble like a 2000. Others, real estate like 2007, or debt overload here and there. Then bam, the recession hits. Something snaps, spending drops, over-leveraged folks and companies default. Profits tank and the stocks crash. People panic, layoffs spike, and it's nasty spiral until the central bank slash rates. Both businesses and buyers scoot up bargains, and we're back to recovery. Wild ride, right? All right, now let's chat about the Federal Reserve, the U.S. Central Bank, the grandmaster pulling the economy strings with interest rates. The Fed got this cool gig called dual mandate. 1, keep jobs flowing. 2, keep inflation parked at 2%. So when the economy is tanking, like in a recession or recovery, they slash rates fast. Boom, mortgages, bonds, even your saving accounts yields drop. Flashing, borrow cheap, spend now. People grab low rates loans for homes, yank cash from lame savings to chase stocks, and the business pile in, borrowing to grow. It's a wild, cash-filled party to shake things awake. But here's the twist. All that spending can spark inflation. Prices sneak up like a thief in the night. Cue the Fed flipping the switch, hiking rates. Suddenly, mortgage rates thin, debt weighs heavy, and the saving accounts turn tempting. Everyone hits the brake. Fewer home bought, business shelve big plans, cash gets hoarded, inflation chills, but the move flips quick. Peek at Fed's rate chart since 1955. The 70s and 80s were an inflation inferno, rates soaring to tame crazy times. Otherwise, it's simple. Rates rise in boom times, then crash when trouble looms. High stakes whack-a-mole, baby. So here's the deal. A crash in recovery or growth, sparked by some tech glitches, usually bounce back fast. No bear market doom. But if it hits in a bubble or pops open, you are in for a long, ugly bear market until the mess clears out. Timing is everything. So where are we now? Post-COVID, the Fed slashed rates to zero, bonds like crazy. Economy came back on fire and the inflation shot up by mid-2021. Inflation soared to 7%, peaking at a blistering 9.1% in June 2022. The Fed, caught napping initially, jacked rates up from near zero to 5% and a change by July 2023, a 20-year high to smash inflation down. Stocks tanked in 2022, with S&P 500 plunging a little over 20% to around 3,600. But then, bam, the 2023-24 rebound. S&P soared 24% in 23 and 25% in 24, blasting past 6,000, riding cooling inflation, AI hype, and a new kind of fiscal beast we're going to talk in a second. Federal Reserve also start cutting interests in 2024, but stopped shortly after. GDP held at 2 to 3%. No recession yet. But here are the red flags, though. Stock valuations are sky high. CAPE ratios near all-time peak. Insiders selling at record levels, as shown in our first episode. And inflation-adjusted housing prices, they are nuts as well. Bubble territory, right? Normally high interest rates will pop it, but enter fiscal dominance or structure fiscal deficit, a game changer in the last several years, flagged by Lane Eldon. Now we're talking 11 trillion deficit spending splashed out by federal government since COVID, ballooning the public debt to a jaw-dropping $36 trillion. Back in the day, government borrowing was a recession lifeline to juice things up, balanced later by surplus. Not anymore. Now deficits are baked in. Think aging folks needing Social Security, Medicare, and the crazy healthcare costs, plus nearly net $900 billion in interest payments alone at current interest rates. That's almost $1 trillion just to keep the debt lights on. And the spending are not optional. It's structural, driven by obligations we cannot dodge. Here's the wild card. This spending plus interest rates is now outpacing private lending. And the Fed moves as the economy's rocket fuel, and it's flipping the script. The fiscal monster outmuscles Fed rate hikes. Normally, rate hikes cool inflation, right? But now they jack up government interest payments, widen deficits, and they keep the economy buzzing, feeding an inflationary loop. Private debt's mostly fixed rate, shrugging off hikes as well, while government cash just plugs any gaps. Traditional Fed tools kind of toothless now. Rate hikes might even stoke inflation instead of taming it. And the private investment shrugged them off, with $7 trillion in annual government spending growing fast. Even the Doge, the Department of Government Efficiency's dreamy $1 trillion cut. Elon Musk says he's going to cut $1 trillion. It's not going to dent this beast much. So are we doomed? At least not yet. Everyone still loves our dollars, and we owe the debt in our own currency. Barring war or a doomsday meltdown alike, it's probably less a cliff-edge drama, but more of a slow, sticky mess. So bottom line, we are deep in bubble territory. Stocks sky high, insiders cashing out like crazy, and housing prices off the charts. The Fed jacked up rates and kept them not too low from there. But here's the wild card. Fiscal dominance is propping things up, twisting the old playbook, softening the rate hike punch. A crash still feels inevitable. But when and how? That's really the million-dollar question. Obviously, the CCP's invasion of Taiwan for sure could be one we talked about in our episode 2. But now, buckle up for something wild. One of the possible another how Jim Rickards called AI doom loop in his book Money GPT. Imagine a financial catastrophe unlike anything we've ever witnessed. Not a dot-com bubble, not 2008, not even the COVID crash, but a terrifying new monster unleashed by artificial intelligence. A market crash amplified by AI trading systems, ready to shred wealth at a speed and scale that defies comprehension. Wall Street's top bank, think Goldman, Morgan Stanley, and Citigroup, all in on AI models, like JP Morgan's Moneyball, set to launch by April 11th. These are not just tools, they are powerhouses. An experimental AI trader, Candlelight, outshines the S&P 500 and Warren Buffett in live tests. Zero human needed. Backed by 71 studies, these deep learning AIs can swap out 30 million traders' salary for tireless, cost-free robots that trade at lightning speed. Here's the kicker. The curse of scale is a dark force behind the chaos. Imagine a kid at a Yankee game standing on his seat for a killer view. Perfect. Until every fan does the same, turning the stands into a chaotic mess where no one sees anything. That's AI trading. One bank's AI wins big, but all firms deploy clones trained on the same Wall Street data. They crowd the same trades, strangling profits. When one AI sells, the rest mimic it instantly. No contrarians, just a stampede tanking the market in a flash. Rickards predicts a 20% plunge in 2 hours, a free fall sparked by AI traders. Then when circuit breakers, those flimsy safety nets meant to halt the chaos, passes and the trading resumes, another 20% vanishes in a heartbeat. What sets this apart from past crashes, like the program portfolio insurance selling off the 1987 Black Monday, is the sheer autonomy and the uniformity of these AI systems. Back then, preset algorithms blindly dumped stock based on rigid rules, but humans can still intervene. And the damage, while brutal, it wasn't instantaneous across the board. Today's AI traders, trained on the same data sets, act like a synchronized swarm with no human oversight, rewriting their own code, racing to the exits at a millisecond speed. Unlike the varied instinct of human traders or the predictable limits of old school algorithm, these AIs amplify each other's panic, creating an exponential feedback loop. In this bubbly market valuations, fiscal weirdness, it's a powder keg. Wall Street's greed could unleash a financial Hiroshima. Now we're going to dive deeper into this beast another time, but preparation is key, is your only shield. But do remember though, a stock market crash at the bubble peak doesn't necessarily need a dramatic spark. Valuations soared too high. One nervous investor bails, then another follows suit. Suddenly, it's a frantic sell-off like the tech wreck of April 2000. Chaos erupts and pop goes the bubble. So, there you have it. Crashes from busted machines. Bear markets from economic cycles. A bubble twisted by fiscal dominance and AI doom loop, looming like a sci-fi horror flick. History's littered with warnings. The 34% COVID drop, the 50% Great Recession plunge, 78% Nasdaq.com wipeout, and the 90% Great Depression nightmare. And the next one is coming. What can you do? In our next episode, we're going to arm you with simple and advanced strategies to protect your portfolio. All right, folks, that's a wrap for today. Thanks for joining us. We hope you enjoyed the ride. If you're loving what we are bringing to the table, don't forget to hit that subscribe button and notification bell. Give us a like and share the vibe with your friends. We'd love to hear your thoughts, so drop a comment below and let us know what's on your mind. Stay tuned, and let's get ready together.